Do you have a substantial amount of your net worth tied to one single stock? For many senior executives and investors that I work with, the last couple of years of major market growth have led to an incredible percentage of concentrated holdings. In some cases, I've seen executives have 50% of their retirement, sometimes even more, in one single company. And as we're all aware, concentration is the single best way to grow our wealth. But it's also the single biggest risk, and it's the quickest way to lose our wealth. So in today's video, I'm going to go over the 5 strategies that I'm using with people like you to help manage risk in an appropriate way for their goals. I'm Brennan Decima, owner of Decima Wealth Consulting, and I've spent the last 2 decades helping senior executives transition risk and protect their families efficiently in retirement. Let's get started. All right, there is no disputing that having money in a single position can lead to a dramatic increase in your net worth. And a really good example of that is if you had everything in NVIDIA over the last 10 years, you would have made an absolute fortune. We've seen people like Bill Gates and Warren Buffett, Elon Musk, Jeff Bezos, they've become mega billionaires by taking concentrated risk. But the statistics say that that is not the normal. That is the outlier. And over the last 10 years, the majority of the S&P 500 has actually underperformed the index. So we're now potentially taking more risk for less returns. And a lot of great companies, even the ones that are leaders of their industry or transforming the economy, have gone through periods where they've dropped 50% in any given period. So a lot of executives over time, their priorities change. They shift from, hey, let's accumulate as much wealth as possible to let's preserve what I've made and worked so hard for. And I want you to think about this. The quickest way to accumulate wealth is through concentration. The quickest way to lose wealth is also through concentration. So remember, concentration builds wealth quickly. Diversification preserves wealth. So in this video, I'm going to go over 5 strategies to consider as you think about your concentrated position. And let's go over the pros, the cons, and what to consider so you can make an informed decision for your strategy. All right, so let's start with the first strategy, and by far the easiest strategy. And the first strategy is to leave it alone and do absolutely nothing. And that's a great strategy if nothing goes wrong. The stock continues to appreciate, maybe it outperforms the S&P, maybe you become parabolic in your returns and you're the next billionaire, right? But for most people, hope is not how they want to navigate years and years of hard work of building that nest egg. So leaving it alone really relies on a few things. It relies on a little bit of luck, and it relies on everything going the right way. And for some, that'll pan out. For others, it won't. All right, so the second approach, and this is a really easy approach, is to just liquidate the position and pay the taxes. You place a sale order, you write a check to the IRS, you get the cash, and you can diversify it in a way that now aligns with your current stage in life and the goals you have for your family and your net worth. Really easy. So why doesn't everyone do this? Well, there's really 3 reasons. Number 1 is psychological. Most executives I work with have a sentimental attachment to the company that built their net worth, especially if they've done a really good job at that. Other people have sentimental value because they don't want to reinvent the wheel when they have something that works. A really good example of that is if you bought NVIDIA in single digits and now you're selling it over 200, kind of feels like you're betraying what's worked, right? So the emotional impact of that is a very, very real hesitation that a lot of people have. Number 2 is the tax cost. If you sell it, you immediately need to write a check to the IRS. And in most cases, that's going to be 23.6%. And potentially state taxes on top of that. That immediately reduces the amount you have to grow. It slows your compounding. And then number 3 is the step up in basis. So a lot of people are aware that when they pass away, those capital gains will be forgiven. Their heirs will get a step up in basis and they only pay taxes on the growth from the date of death forward. So a lot of people don't want to give up that tax bill. The third strategy is using options to buy a collar. And options may be overwhelming and intimidating to a lot of people, but there's some really good practicality into when and where this fits in. So when you use a collar, you are not selling the shares. You're essentially controlling a range of outcome. And the way that you do that is you are buying a put on your holding. Now, a put limits your downside. It is essentially adding insurance to your position. Now, when you buy a put, it has a cost. So to offset that cost, you sell a call, which earns you income. That income pays for the put. Now, what that does is two things. If the stock drops below a certain price, you're protected. You have that insurance. But on the other side, if the stock goes up, you've sold a call. You're limiting your upside. So where and when does a collar fit in? Well, you may be someone that really depends on the dividends and the cash flow from your holding, but you want to limit the volatility. You want to reduce the stress. Well, a collar is a great way to reduce the range of outcomes without getting out of the holding. So it caps your upside, it limits your downside, it still allows you to collect that dividend, but you're not getting out of the position. You're just reducing the risk. You're reducing the sensitivity to volatility. So really, really good approach if you still believe in the company, but you don't think that it's going to continue to grow. It's just going to be more of a cash flow based investment. Now, the reason that most people are hesitant of this is if you don't believe the stock is going to grow, why not just find a better investment, right? If you do think the stock is going to grow, well, you wouldn't use a collar because you're capping the upside. So this is really, really powerful for someone that may be having health issues or close to passing away and really wants to preserve that step up, but wants to protect themselves and still collect cash flow. Strategy 4 is a little bit less common and a little bit less publicized, but it is using what's called an exchange fund. And the way that an exchange fund works is you're not selling your shares, but you and other investors with different companies with different capital gains contribute your shares to a pooled fund. And in return, you receive slivers of shares of all those other companies to diversify the risk. Now, the benefit of that is it allows you to diversify without realizing capital gains. It does not eliminate the capital gains, it defers the capital gains, but it allows you to diversify without giving away money to taxes and reducing your compounding along the way. Now, the challenge with the exchange fund is there's typically a lockup period for exchange fund. There's normally higher minimums, but it's a really powerful way for those that still have a really long time frame that don't see a scenario where they need the money to reduce exposure, diversify risk without stroking that check for the tax bill. All right, and the final strategy I'm going to discuss is the long-short strategy. And this is a more sophisticated strategy. It's typically for executives and investors that have a net worth of over $5 million and at least $1 million in one position. But this is a strategy for investors that still have a really strong conviction in the holding and the future growth prospects, but either their situation has changed or their needs have changed, and they recognize the importance and value of diversifying and reducing risk. However, they want to do it without stroking a huge check to the IRS, so they're looking for something that allows them to reduce risk in a tax-neutral way. And that's where the long short comes in. Now, the nuts and bolts in the strategy of this, and I'm not going to get into the weeds, happy to discuss this on a one-off, but you still hold the position. You're not exchanging it. You're not capping the upside. And using leverage, you are building a correlated position of securities around it. And this allows you to use market volatility to your advantage. As the market moves up and down, it will generate losses to allow you to diversify your concentrated holding without paying capital gains. Now, the more leverage that is deployed, the quicker you can diversify your holding. Now, The catch with this is obviously leverage presents its own risk. Obviously, there's cost involved. It's typically for sophisticated, savvy investors. A institutional money manager normally gets involved in this scenario, and you need to get approved for that margin loan. But for executives that have millions of dollars in a single holding, this is a really powerful strategy that allows you to still appreciate without capping the upside, but very, very quickly diversify without paying capital gains. This is also a popular strategy for those that have a liquidity event. Either they're selling a business or they sell a property or a home and they need to quickly offset capital gains. So the long short, again, not for everyone, but it's the last thing that I'm going to discuss as a way to reduce risk in a tax-neutral way. To recap what we've discussed, there's 5 major ways to handle a concentrated position. Option 1 is to do absolutely nothing and rely on hope. Hope that nothing goes wrong, hope that it works out. Number 2 is the simplest way. It's to just sell the position, pay the tax bill. It's the quickest way to reduce risk, rip the Band-Aid off. Number 3 is to hold the position, but to limit the range of outcomes by using a collar, capping the upside, but capping the downside. Number 4 is deferring taxes, exchanging it, trading away a little bit of flexibility and liquidity, but reducing that single stock exposure. And then the final way is using leverage to create tax coupons to quickly unwind it without paying the tax bill or capping the upside. Now, the hardest part is not necessarily deciding which one of these makes the most sense, but it's actually taking the first step to do something. And after years of growing wealth, inertia becomes a really common strategy. Option 1, believe it or not, is common, right? Doing nothing, whether it's by paralysis. But in my opinion, hope is not an appropriate strategy. For those that have done a wonderful job building their net worth, building their nest egg, it is incredibly important to align those investments with where we are in life and what our goals are. And if that investment no longer aligns with our priorities, then we need to evaluate the most effective way to get to where you are today to where you need to be tomorrow. And if this video is helpful, please subscribe. If you have someone with concentrated positions, feel free to share. And I hope to see you in the next one. Have a great day.